Hi, I'm Jennifer Thompson, and today I'd like to get into greater detail on the case for asset allocation. Asset allocation is just a strategy to allocate your investments in different asset classes, and I had mentioned about the four main asset classes. The first one, cash and cash equivalents, which comprises of things such as money market funds, cash under your mattress, savings accounts in a bank, short-term deposits. That falls under the category of cash and cash equivalents. You want to have that for short-term goals, short-term needs, like a rainy day fund. You want to park some money. It's really good to also have cash sitting aside in case stock markets crash and you want to take the opportunity to jump in, and you want to have some cash to buy some stocks. So that's the first asset class. It's the lowest risk because there's practically no volatility at all. The second asset class I had mentioned is called fixed income, and that comprises of the bond market, essentially the bond market, corporate bonds, government bonds. Bonds, unless you have an individual bond and hold it to maturity, bonds in the interim have volatility. So they're not completely safe, but they're less safe than cash equivalents. But of course, they are perceived as safer than the next category, which is equities. So there's the bonds and then equities. Equities are shares, stocks and shares. It's really ownership in a company. Equities generally are perceived as more risky than the bond market. And what's interesting is why you want to have both of them in your portfolio is because bonds don't work quite often. Bonds and stocks work in opposite directions. Quite often when the stock market falls or undergoes a major correction, then there's flight to security, and quite often bonds are seen as more secure. So you want to have a bit of both. Equities are generally more risky, and so if you're going into equities, buying stocks and shares, it's with the idea that you're going to be able to hold them for the longer term. It's not jumping in and getting out the next day or going in to speculate. That's different. That's not investing. That might be speculating, and I'll talk about that in another video. But so there's cash and cash equivalents, fixed income, which is essentially bonds. Third is, of course, equity market, which is stocks and shares. Even within the equity space, there's a huge variation. Stocks held in a blue chip stable bank might be seen as safer, less volatile than, let's say, buying stocks in a mining company. So even within the equity space, there's a huge variation. And finally, alternative investments. Alternative investments are the most speculative. They tend to be the most risky. And you should never put more than 5 to 10% of your entire portfolio in that. Some people are really into speculating, and that's up to them. But the alternative investment space includes derivatives, options, also includes things like Bitcoin and maybe holding gold and silver. So, and even art. So alternative investments are really for the long term, unless you're really into speculation. And alternative investments have the potential to, to blow up really in sight, or to disappear like a brand new mining stock, or maybe holding gold and silver, which has shown to be extremely volatile, and so is Bitcoin. So the alternative investment space is generally highly speculative and highly risky. If you're saving for retirement, or you're saving for a down payment on a house, where you know you're going to need that money, then you do not want to put a lot of your portfolio, or a large portion of your portfolio, in what I would call the alternative space. If you're a very sophisticated investor, that might be a different case altogether. But so those are the four classes in greater detail. You can see that they all have a different place in your portfolio, and depending on your objectives and your risk tolerance, that will determine how much of your investable asset you're going to put in each of those. I'm Jennifer Thompson, and that's a lesson on asset allocation and why you need it in my Investing 101.